Hello, everybody, and welcome to another one of IRONSHIELD Financial Planning's Fly on the Wall webinars. For those of you who don't know me, my name is Scott Plaskett. I'm a certified financial planner and the senior financial planner and CEO of the fee-based financial planning firm IRONSHIELD Financial Planning. If this is your first time tuning into a Fly on the Wall recording, let me quickly explain to you what this is. You're going to experience what it's like to be a fly on the wall during one of my update calls with a member of our Top Guns network. This network is my personal network of specialists. Every so often, I ask a member of my network to touch base with me to bring me up to speed on the latest happenings in their area. And when they call me, I record the call so you can be a fly on the wall for that call. On today's episode, I invited Mike Flux, Senior Vice President and Portfolio Manager at Connor Clark & Lund Private Capital, to chat about their investment outlook. We also discussed how to interpret the current events and how to properly position portfolios to take advantage of these market events. He shares a very well thought out and disciplined approach to investing in today's environment. Now, here's the call. Okay, Mike and Ryan, listen, thanks guys for taking the time and going through some alternative discussions. And it's part of a portfolio that is such an important part, especially in this economic environment when we have such low interest rates and really are challenged on a lot of traditional asset classes. People are asking the question, well, where am I going to make a good balanced portfolio? Where am I going to get all my returns from? And the great thing is when you've got a toolbox that has extra tools in it, such as the alternative investments that we're going to talk about today, it just allows for people to build better portfolios moving forward. So I always like to get an update on what's been happening in this space. It's a very exciting space as far as I'm concerned, not in the sense that it's a very volatile space. It's just a space that just offers more opportunities than most people are able to take advantage of. So Mike and Ryan, I'll pass it over to you guys, and you can just give me an update on what's going on there.
Sounds good, Scott. I just want to take a quick second to introduce Ryan McNerney, who's joined my team at Connor Clark & Lund. Scott, as you know, our relationships expanded over the years. We have a large number of clients. IRONSHIELD and Canada Financial Planning Syndicate continue to grow, and so congratulations on everything there. And just out of respect for that, we just wanted to layer on some additional support and make sure that clients are getting access to Connor Clark & Lund when they want to hear from the money manager as to what's happening in the markets, what decisions we made, what's worked, what hasn't, where do we see the world going, what are we doing about it, that kind of regular dialogue. And so, it's with that in mind that I brought Ryan in to kind of work with me and work with you to service your clients even better. So I might just have Ryan say a few words, and for everybody listening, don't be surprised if you see Ryan's name appearing on things, or if you hear his voice on the other side of the line, or if he's showing up at meetings, because Ryan and I are really working together now to service your needs.
Thanks, Mike. Thanks, Scott, and thanks for inviting me on the call as well. Yeah, I'm happy and excited to be part of Mike's team here at CC&L. I joined in 2015 and have been servicing high net worth families and organizations across the country for over a decade now. I think this alternative mandate is what particularly made my decision to move to CC&L that much more interesting or easier for me. Second to none in terms of the solution set, and in terms of adding it to portfolios when moderating volatility and increasing that potential to reach a longer term target. So I think they're great solutions to include in a portfolio. And with that, I'll leave it with Mike.
Great. Yeah. So welcome, Ryan, to the team, and I think all of you can look forward to hearing from Ryan and I as time moves forward. So I might just kind of start on a slide that shows all the various asset classes that we can invest for Connor Clark & Lund clients. We're going to focus the conversation on the three here in the alternative section, and you can see what we don't like, what we like the most, and what we're somewhat neutral on. And we really do like the alternative investments for a variety of reasons, and that hasn't changed much. We've gone from favoring them to favoring them a lot to favoring them a little bit less, but they've always been on the far right side of this chart versus Canadian stocks and global equities that have moved from not liking it to liking it a little bit more. Bonds we've been pretty negative on in the past. Short term we like it a little bit more. We've got to be very tactical in this area. What's interesting about this area is that it's more a strategic decision to incorporate these things, these asset classes that work differently than all of the traditional markets. And what essentially allows us to do is ideally improve the returns that clients are getting with less risk. And it's all about, in our mind, preserving a growing capital, getting the best risk-adjusted rate of returns. And the public markets have become very volatile and very emotional, almost like a light switch, risk on, risk off, money in, money out. And these alternatives bring a little bit of stability to the portfolio, and I'll show you the impact that they can have. So first, quickly, the multi-strategy portfolio, what it is it's a market-neutral portfolio. There's no traditional market risk, interest rate risk, currency risk in the portfolio. The gross return objectives are 6 to 8%, and the gross risk is 6 to 8%. Now, put that in perspective. This is bond-type risk with stock-type performance. That's what we're trying to do in this portfolio. And we're trying to eliminate the traditional risk that you get out there that tend to be more emotional, like market risk. Interest rate risk is somewhat out of our control, and it's here to stay. Currency risk has been out there as well. Last year, it impacted the Canadian economy quite tremendously, and it helped global equities to outperform. This year, it's worked in reverse. So we have 3 different market-neutral styles, so we can literally make hundreds or thousands of different investment decisions as to what do we like the most, what do we like the least, and benefit on both ends of that trade. And I'll just use an example. So with the banks in 2008, if you were diversified into the banks and you bought TD and CIBC, maybe that wasn't such a good decision, right? Because when Lehman went under, TD went down 50% and CIBC went down 70% from its high point. And if you were diversified into both, you would have been down 60. What these managers, what our managers here can actually do is they can bet on TD doing a better job than CIBC, buy TD stock, sell short CIBC, bet on it going down. So while we lost 50% on the TD trade, we could have made 70 on the CIBC trade, and that's where we would have made a delta of 20%. I mean, so this is getting fairly technical, but it shows you how we've been able to, with one trade, eliminate the risk of Canadian banks by betting on one doing better than another. Now, if you stack that out over hundreds of pair trades like that, in a general way across the portfolio where the amount of dollars that we're betting on the market going up and the amount of dollars that we're betting on the market going down is equal, that's what makes it market neutral. And it's a fairly sophisticated portfolio that we're running here. Canada Pension Plan hired us to do some work on this for them back in 2004, and now fortunately we're able to incorporate this into all of our private client portfolios. And you know, even if I'm conservative about our return expectations here at 5.5 relative to core bonds at 2, if we're looking at a similar risk profile, that's a pretty attractive decision to incorporate that. And you know, there is times where multi-strategy might underperform bonds, but you can see that most of the time it has outperformed. In particular, where we sit today, moving forward, we'd expect it to outperform bonds. So where possible, we try to incorporate this. It's something that's added a lot of value over the past years. We expect it to add value moving forward. And it also trades every day in the market. It's a liquid portfolio that is in the public markets. It just works differently than stocks, bonds, and cash. So it's something that we tend to recommend for clients that have enough money to incorporate this. A quick blurb on real estate here. You can just see that the portfolio is nicely diversified across the country. Ontario represents half the portfolio, but we got good representation in many of the other provinces, even some properties in Saskatchewan and the Maritimes. We're about a third apiece in retail, office, industrial, which has been the goal. And you can see that our lease expectations tend to be quite long-term, so we don't carry a lot of volatility there in terms of the leases maturing and potentially having to pay higher rates on mortgages. We do have some coming due every year, but that's staggered out over a long period of time, and many of them are well in excess of 6 years. Got a good group of tenants in there. Here's some examples. Really, our focus here is to buy retail and industrial office in Canada in high demand, low supply markets, and ideally buying buildings at low market rents, so we can work to add value to bump up those rents. The objective in a portfolio like this is 8 to 11. We've now delivered close to 12% on a gross basis since inception. Last year was a good year; it was up 9%. But in general, we'd expect around that 8 to 11 over a long period of time, with about half the volatility of stocks. And here's just a recent capital call. Just back in March, we picked up these 3 properties, 2 Toronto-based. This one's probably the most recognizable one for anybody that lives in the core of the city. But this is North Toronto Station. It's the old train station that's now occupied by an LCBO. It's the second best performing LCBO in the chain of LCBOs. And as most people would know, LCBO is the biggest retailer of booze in the world. So quite a nice client to have LCBO in there. And the beauty of a retail property, the better the tenant does, the more you can charge in rent. And because this is the second best producing store out there, when this lease comes up for renewal, we'll be able to negotiate up the rent. And for anybody that lives close by, or even if you don't, we encourage you to go a little bit out of your way to shop at this store, because the more wine you buy here, the better off we'll do as investors in the portfolio. So I appreciate everybody's consideration of that. This property here, 1400 Castlefield, it's in the housing district of Toronto, right around Dufferin, Lawrence, Caledonia Road area. Quite a nice property, and here's a large portfolio that we picked up in called Anthem Portfolio in BC and Alberta. So that was quite a large capital call. We actually do have a capital call coming up on infrastructure. We had one just a little while ago, a small one, but we got a bigger one coming up in short order. We'll be able to tell you more about it on the next call. Infrastructure, here we're investing in traditional infrastructure, like helping provinces to build schools, hospitals, highways, energy infrastructure like run-of-river hydro, solar, and you can see a number of investments that we've made. We're quite heavy on the energy side. The goal is to go 50-50, but we've really made hay in the solar space while we can in Ontario, and we've got some quite an attractive portfolio there. 3 projects that represent 100 megawatts a piece. We're certainly one of the biggest players in Canada, one of the biggest players in North America in this space. By credit, you can see the quality is very high. AAA is as good as it gets. AA is the second best. We're not taking on a lot of counterparty risk here. We're dealing with provinces or power authorities that are controlled by the province. And what's changed a little bit is that we got way less in the construction phase now. A lot of these assets are operating and kicking out a nice long-term, stable, tax-efficient cash flow. So clients now are starting to see a quarterly income coming out of these things that are quite attractive. So here's some updates on Hunter Creek, which is a new addition to the portfolio. There was a capital call on that just a short while ago, and we just refinanced the Grand Renewable Solar project, which is one of the 100 megawatt projects that I talked about, and so that really is the fact that we're able to refinance it has de-risked this important investment for all of us. So when you bring it all together, I mean, clients can invest in a variety of ways, strategically speaking. So this is a conservative portfolio that's 25% stock. This is 55 stock. This is 75. The diamond is the average return we'd expect without any of these alternative investments over the long term. So not a bad return expectation here. You know, stocks do 7 to 9, bonds do 2 to 4. 6 would be a reasonable gross rate of return, but it's not going to be 6.2 every year. And what this is showing, the range between the two, is what an annual return could look like 80% of the time. It could be anywhere from -8 to +20, anywhere in between. 10% of the time, the returns could even be better than this. But there is the chance, 10% of the time, where returns could be worse. And we're showing even the percentage likelihood of a 20+% decline happening once in the next 25 years. And that risk goes up the more risk you take. But this is not a bad outcome, where most of the time the returns are within a reasonable return range. But if you just add 10% multi-strategy, 5% real estate, 5% infrastructure, look what happens to your risk and your return. Generally, you want to have low risk, high return. You want to be up here as much as you can in the northwest quadrant. But what this is showing is for all of the portfolios, there's a positive impact to incorporating some of these alternatives to the mix, whereby you're reducing the risk and increasing the return. So somewhat having your cake and eating it too. Where possible, we'd like to deliver this for clients. So for anybody that's interested in learning more about how we can bring these to the portfolio, or for clients that have it, certainly happy to spend more time updating you on what's going on within these portfolios. Very quick update here on private equity. We've got 5 existing investments, one that we've sold out of. We sold Party Packagers to Party City many years back now, and that was a good return outcome for us and our clients. These are all active investments. We tend to approach this market of partnering with good business owners that are generating $2 to $10 million a year in earnings, and we'll buy anywhere from 20 to 80% of these businesses to share in the profits of this business for 10 plus years or even decades to come. And we've been very happy with the performance of our portfolio across the board. And here's just a number of examples that show the kind of investments that we've made. All, in our mind, very stable investments that are delivering decent cash flows that we can distribute out to clients on an annual basis. Across a portfolio of investments like this, we'd expect 20 plus a year for our money, and we are investing our own money into all of these alternatives. For clients that want to participate, certainly happy to share more about this. This could have a positive impact on the portfolio.
Well, that's great, guys. Listen, I appreciate you taking the time to go through that because, it's an asset class or it's a component of a portfolio that without it, I mean, your one chart there shows it all. You're just simply able to do two very important things to all portfolios: reduce the risk and increase the expected return. And that's what we're always striving for. We're always striving to get rid of a lot of volatility, reduce the risk, and we're looking for more consistency of return. And in this environment that we're going through right now, where we've got really low interest rates, and we're just people who are tend to be more conservative are just saying, well, I'm conservative, but I'm not earning what I need in order to keep my portfolio, to outpace inflation and to outpace some of the taxes and actually pay me a cash flow that I need to live on in some cases for people who are living off of their portfolios. So it's asset classes like these that really enhance things, and having them in the toolbox, so to speak, in order to incorporate them in is just such a valuable component to building an overall greater portfolio. So thanks for going through that and explaining it the way you did, and hopefully it gives people an understanding about the asset class. And should they want to find out more, just reach out to the planner they're working with, and we'll be able to take them through the learning curve a little bit more. Thank you for listening to today's call. If you require further information or have a question relating to today's call, please go to the comments section in the show notes below. Ask your question or make your comment and we'll respond directly online. If you would like to take advantage of a free, no obligation appointment, please call me at 416-626-6515. Or you can visit us on YouTube by checking out our YouTube channel, youtube.com/IronShieldCFP. Follow me on Twitter, twitter.com/IronShieldCFP. Like us on Facebook, facebook.com/IronShieldCFP. Or you can connect with me on LinkedIn.